Okay, so today's topic, capital budgeting. Okay, when you think about budgeting, you're thinking, okay, we're going to spend X amount of money on utilities, heat, light, power, labor, taxes, insurance, etc., etc. That's not exactly what this is about. What this is about is we're going to consider spending a great deal of money today on some capital item, a large expenditure. Let's say in our example, what we're going to do is we're going to look at a large expenditure for equipment. So what we're going to do is we're going to consider a situation where we're going to buy new, better, faster equipment, and we're going to sell off the old equipment. So everything that we calculate, we're going to have to figure out the difference between the new equipment and the old equipment. All right, so that's going to be our initial investment. When we get to that number, that's going to be one big negative number, yeah? And since the money is going out today, it's dollar for dollar, negative cash flow. Now, we want to evaluate the wisdom of this expenditure, yeah? Should we or shouldn't we? So how we're going to do that is we're going to look at the cash flows. We're going to call them incremental cash flows. The difference between the new equipment versus the old equipment. So this would be the additional cash coming in if you do what? If you get the new equipment. All right. So that's going to be another calculation. In this example, it's going to be a 5-year timeline. We're going to buy the equipment, the new equipment, or think about buying it. And then we're going to look at the cash flows for the next 5 years, which I call operating cash flows. All right. Remember, it's the difference between the new and the old. Now, terminal cash flow, what's that? Well, we're going to say at the end of the 5-year timeline, we're going to sell off the new equipment. And maybe we'll buy another wing bang model, okay? So that's going to be at the end of the last year. So you notice that I have year 5 for both of these. All right, so first thing we have to do is we have to figure out what are all these cash flows. And then we want to figure out what's the present value of these cash flows which are out in the future. You, of course, being a star corporate finance student that you are, realize that these dollars here out in the future are not worth as much as these dollars over here. So what discount rate are we going to use? Well, that would be determined by the corporation. How much of an interest or how much of an earnings is satisfactory? Now, in our example, I'm going to go with 8%. I'm going to say that our company is going to lay out all this money, and they're hoping that they can get at least 8% on the money spent day one. So this becomes then a present value question. What's the present value of this? Dollar for dollar. What's the present value of these cash flows? Well, we have to figure it out at 8%. Now, when we figure out what all this stuff here is worth in today's dollars, is it equal to or greater than the initial investment? If it's greater than the initial investment, we would say that it has a positive net present value. In other words, these incomings exceed this outgoing. If it has a negative net present value, that means you didn't earn 8%. Okay, so we would have to ditch this project, yeah? All right. One other thing, and this is something that we're going to need a special formula for, the internal rate of return. What is that? Well, we're going to look at this, and we're going to consider 8% as being the bar, right? We have to get to that number. Let's suppose we wind up with a positive net present value. Are we earning 8%? No, we're earning more than 8% if we come up with a positive net present value. So what is the internal rate of return? It's the discount rate which makes your NPV 0. It tells you what your rate of return is on this investment. So what interest rate here will make your net present value 0? Okay, we'll get to that. Sounds impossible, but we're going to do it. Okay. All right, so first of all, let's figure out our initial investment. Now remember, we are buying the new, and that's the easy part. How much does the new cost? Well, the new whiz-bang equipment costs $950,000. Yeah. All right. So now, what is the initial investment? Well, it's not 950 because if we do this thing, we're going to sell off the old. So we need to figure out the after-tax proceeds on the old equipment. So the assumption is here that January 1, 2001, we're going to sell the equipment for $120,000. We're going to sell the old equipment. We're going to take whatever the after-tax proceeds are and subtract them from the 950. That's how much money we're going to be out day one. Now, in order to figure out what the after-tax proceeds are, we have to figure out what the tax basis is of the old equipment. Yeah. Now, if we were going according to GAAP, we would say we got to calculate the book value of the equipment, but that's not what we're doing. We're calculating the tax basis. In other words, what is the undepreciated cost of the $500,000 that we spent on June 20th, 2015? All right, so the way that it works, we have to calculate the tax basis because that's what's going to determine what the taxable gain or loss is. So if we bought the equipment in 15, and according to the IRS, our equipment is a 7-year tax asset. In the real world, you can look these things up. Okay. You say, okay, what kind of equipment do I have? You could look it up in the IRS depreciation module, and you could come up with this, which is a 7-year asset. That's going to be a given. And if that is the case, then these are the depreciation rates for, you say, wait a second, I thought you said 7, it's 8 years. Well, this is supposedly a half year up here, and this is supposedly a half year down here. So theoretically, it's 7. Do we care about this? We do not. All we know is the following, that in 2015, when we bought this equipment, the depreciation that we would have recorded would have been $500,000 times 14.29. That's how much depreciation we would have recorded in 2015. But that's not what we want to figure out. We want to figure out, well, how much depreciation in total was recorded and what is the undepreciated cost. So, whoops. Let's do this. I'll just put the years in here. Always good to figure out exactly where you are on these years, because if you got the wrong year, it comes out wrong. Okay, so in the second year, we would have recorded $500,000 times 2449. Yeah. What about the other years, you say? And you're going to see in a couple of minutes that we really don't need to do all this stuff, okay? But that's how much depreciation you would have recorded as of 2020. Yeah? The end of 2020. So this is 21 and 22. All right. This is how much depreciation we recorded already. How much was the original cost? $500,000. So what's the tax basis? $66,950. Now, do we have to go through all this nonsense over here? No, we don't. So the shortcut is, these are the years that didn't happen yet. Of course, these percentages add up to 100, yeah? So if we just use these last two rates, which are published, okay, so we know exactly what they are. We just take those two rates, add them together, and multiply times $500,000, we should get the undepreciated cost of $66,950. All right, so this is 2021, 2022. This is $500,000 times 893. And this is $500,000 times 446. I think I left a zero out. There you go. That's how it works. The observant student will note there's no salvage value, right? You just take whatever the cost of the asset is and you start multiplying away. And as we sit there at the precipice of 2021, this is how much the old equipment's tax basis is. And we're going to say, all right, now what if we sell this equipment on January 1st? Well, we're going to compare what we got for the equipment, the old equipment, to this number here, and that's going to determine our gain or loss. All right, so let's go over here. How much did we sell that equipment for? Looks like 120K, yeah? All right, so this is the way I do it. This is my way of doing it. There are other ways. I like this setup. So that's going to be the sales proceeds from the old equipment, which we want to compare to what? We want to compare that to the tax basis of the old, which we just figured is 66,950. We have a gain on the sale. That's the good news. The good news is you have a gain. The bad news is what? You have to share. Share with whom? The state and federal government. And God forbid you're inside New York City, you got to share with those people as well. All right. 21,220 is the tax. Bad news. Good news, you got 120. What's the difference? I got $98,000 after tax for the old equipment. Now, if I go with the new equipment, I am going to collect this 98K, and I'm going to offset it against the 950, and I'm going to get to our number, which is the initial investment. Yeah, yeah? The initial investment. Take the cost of the new, deduct the after-tax proceeds of the old. Bingo! Initial investment. Yeah, yeah? What if we sold the asset for less than $66,000? Well, you're thinking that would be a loss, yeah? And you'd be right. So if we have a loss on the sale, and the observant student will note, that changed automatically. He didn't type that, did he? Well, I put a little conditional cell reference in there. That if this cell F36 is greater than 0, then I want to see gain on sale. That's what's inside the, okay? And if it's less than 0, I want to see loss on sale. So that's what happened. All right. That's a pretty cool thing to do. All right. So if we had a loss of 16,950, bad news. Good news is what? We're going to apply that to other taxable income. We're going to get a tax benefit. So you add the two numbers together. There's your proceeds, deduct from the 950, and we're good to go. But we're going to use the 120. So I'm going to install this number as my initial investment. Come back over here. And that's going to be a negative, yeah? So I'll just put in my, whoops, didn't mean to. Minus whatever this number is here. 851,220. I got one number. I got to get all these other numbers. All right. Well, before I do the operating cash flows, we're going to calculate the terminal cash flow. So what is it that we can get after taxes for the new equipment, which we're theoretically selling off at the end of 2025? Yeah? I believe that's the year. Yes, it is. What could we get for the new equipment after taxes? What could we get for the old equipment after taxes? What's the difference? The difference will be the terminal cash flow. All right, so we have to figure out the tax basis of the new equipment in 2025. Yeah, yeah? At the end of. So we got 2021. And if everything goes according to plan, at this point in time, we'll sell off the new equipment, new in 2021, and maybe we'll get something else. So that's going to be the undepreciated cost, that 576. Again, these add up to what? They add up to 100%. So that number represents the undepreciated cost of the new machine at the end of 2025. All right? So there's my new machine cost. That's how much is going to be left. All right, let's look at the calculation now. Okay, proceeds from sale of new equipment is going to be how many dollars? Whatever the problem says, right? 150K. Okay, what's the tax basis? So we'll take the 950,000 original cost and multiply times that 1 year didn't happen yet, around 2026, and we get 54,720 as the tax basis. All right, that's the good news, right? Good news is we're going to have a gain on this. Changed automatically, okay. And the bad news is we're going to have to share, right? We're going to have to share to the tune of 40%. We're going to call that the marginal tax rate. So we'll take this and multiply times minus 0.4. And we'll get 38,112 as the tax on this 95K at 40%. Then we'll find the after-tax proceeds, 11,888 after-tax proceeds of the new equipment in 2025, end of, yeah. And what about the old equipment? Because if we go with this project, we are going to forego, we're not going to get the money that we would have had we held on to the old equipment. So how much is that going to sell for? Well, we look at whatever the problem says, right? This is the old equipment, 25K. Now this is 2025. So at this point you say to yourself, what's the tax basis in 2025? You're thinking, stupid question, right? Because this asset will be completely depreciated as of 2022. So for the years 23, 24, and 25, there would be no depreciation on the old equipment, and its tax basis beginning in 2023 would be zero. Yeah. Which makes it a really easy calculation, because if your tax basis is zero, then all the money you get is profit. And if you're lopping off 40%, you're going to wind up with what? You're going to wind up with 60%. But I'll make the long calculation anyway. Okay, what's the tax basis? Zero. What's going to be the tax? The tax is going to be 40% of 25K, which is going to be 10,000. The after-tax proceeds are going to be 15,000. And what is the terminal cash flow? Well, if we buy the new equipment, we'll get that money, but we won't get that money because we sold the old equipment way back in 2020. Okay, so find the difference. And there is the terminal cash flow, which for our purposes we're going to consider that to be a positive cash flow occurring at the end of the 5th year. So I'm going to pull that up over here. Positive cash flow. All right. Now what do we got to do? Well, now we got to figure out all that stuff in the middle. So it would be the operating cash flows. So I don't have a whole bunch of numbers with respect to this, but I'm going to go down here and let's see what we have. So this is what's projected in the 5-year timeline. If we keep the old equipment, we'll have this much revenue. Looks like it's decreasing by 5,000 a year, beginning in 2021. Our costs, and we're going to say they're cash, paid in cash, yeah, cash flow, 42,000. They're 42% of these numbers. If we get the new equipment, we anticipate revenue of $450,000, which descends by, it looks like, $10,000 a year. And our cash out-of-pocket costs, that'd be cost of goods sold and any other cash cost or expense, is this wacky percentage. And there must be a reason for that wacky percentage. And of course there is, but we'll get to that. All right, so there we have it. Now, we put together a little chart. So, I want to compare new to old. Yeah? That's what I want to do. So how am I going to do this? Well, let me drop in the revenue, all right? What's the revenue? 450,000. What are the costs, cash? They are that number. How much depreciation do I get? Year one. Well, I left the rates up here on the top. Where do they come from? They come from this chart. Huh? As per IRS, you get 20%, and then it scales down to 11.52 in the fifth year. 20% of what? 20% of the 950. Yeah. So I want to come down here, and I want to take my 950 and multiply times this number. Now that's not a cash cost, John. You remember that adjusting entry in accounting? Debit depreciation expense, credit accumulated depreciation. But it is a number that you need to use to calculate your taxable income. So I got this as IBT, income before tax, or loss before tax. What do we got? Take the 450, subtract the 145, subtract the 90, 114,092. That's the good news. Looks like we're going to have income before tax of 114,000. And what's the bad news? You guessed it, we have to share. So we're going to calculate the tax on this at 40%, 45,000. Then we get to the net income, take off the tax. We got 159. And what's the first thing you add back on the statement of cash flows? You remember. Add back the depreciation. Here's our cash flow from the new. Year one. 349,000. Got to subtract that, right? 258,455. Okay? Cash coming in, cash going out, based on the IRS schedule. We get the income before tax, take off 40%, there's our net income, add back the depreciation, which is a non-cash expense. Bingo! There's our cash flow, year one. Now all I gotta do is the other years. Well, let's see, let's put a few formulas in here. How about this one will be, take last year, which is 2021, subtract 10,000. So that's how it works. Okay, the cash expenses. Let's take, there's two ways you could do it. You can just copy these numbers, or you can multiply times this rate up here. Let's make it simple. I'm just going to copy these numbers, all right? I copied the wrong number. You know that. All right, here we go. Okay, looks like we got all the numbers in there now, right? That's cash. What about depreciation? Well, that's going to be what? 950 times this. So that should work automatically, right? If I copy this across. The observant student will note that over here, we added together all of the depreciation. And you got 895, 280. What we didn't get is the 2026 depreciation. That's that 05 number. You remember? That's this over here, right? That's 2026. .0576, the remaining book value, or remaining tax basis at the end of 25. see now. What else do we have? Let's copy this across. This should descend by 10,000 a year. Let's add these guys up. That's what this did. And this multiplied by 40%. And this subtracted. And this just pulled that number. And this just added these two together. So we should be able to copy all of these across, which I use the copy icon. That's one way of doing it. This is my way. And then there's a whole bunch of wrong ways. Just kidding. There's a bunch of ways you can do it. All right. There it is. There's my cash flows from the new, starting in 2021 and going out to 2025. Okay. That's the good news. However, if we do this, we do not get the money that we would have gotten had we kept the old equipment. So we have to make the same calculation for the old equipment. So let's see. Let me go over here and grab the revenue number. The revenue number is $100,000 for starters, and then moves down by $5,000 a year. So I'll put a little formula in here. Minus 5,000. The costs are not some wacky number, but they are what? They're exactly 42%. We could just install these in the cash cost cells, or we could put a formula. This time I'll put a formula. Take this, multiply times 0.42. Depreciation. All right, now, what a lot of students do when they calculate depreciation here, which is incorrect, is they say, oh, that's the first year. So let me use this number up here. That's not the right number. We're over here in the chart, yeah? We're in year 7 and 8. So you don't go back to the top. This stuff already happened, yeah? So we need these two rates, and I think I already had them down there, so let's go look at that. There's the rates. What are we multiplying by? I believe it was $500,000, yeah? Yes. All right, so let's take $500,000, multiply times the rate. If we copy that across, it should work for the next year as well, and it's going to give you a bunch of zeros in the last 3 years. Okay, what's the IBT? Well, at this point, we could actually just copy these formulas here, but I'm going to redo it. Okay, let's take your 100,000, subtract your 42, subtract your 44,650. Calculate the tax, subtract the tax, add back the depreciation, and Walenda. We have the cash flow from the old, which you're not going to get because you sold it off, yeah? So we got to take this 52K off of this 258 to get our incremental cash flow. Bingo. 205,795. Where's that number going to go? It's going to go over here. Yeah? All right. Let's figure out the rest of the years first. Let's see, these formulas going to work for us. I think they will. I'm going to copy all these guys across now, and then we'll see if what happens. All right. It looks like it worked. The depreciation stopped here because there's no rate up here. This went from 100 down to 80,000. That's good. And 33.6 is the last number for our cash costs. And there's all our tax numbers. There's our after-tax number. The observant student will note we're not adding back depreciation in 23, 24, 25. The asset is fully depreciated. And if you add these two numbers together over here, what do you get? you get 66,950. Is that a familiar number? That was the tax basis way back in the initial investment land, yeah? That was the tax basis of the old. That was these 2 years over here, yeah? Same number, okay. So this is new minus old, yeah? And now I'm going to plug these numbers in. Where are we going to plug these numbers in? We're going to plug these numbers in on the top of the page. All right, so let me move this. Let's see, what cell is that? That's cell D98. Whoops, didn't mean to do that. D98. Okay. Let's go up here. Drop in D98. Okay. And then we'll just copy this across, and what's it going to do? It's going to go to E98, F98. Yeah, it's exactly what we wanted to do. Go across, all right? Okay. Now what? Now we want to apply the present value factors at 8% to this number. So this number, let's say a year from now, what's it worth today when we're considering spending all this money? What's it worth today? We have to apply the present value factor for a single sum to each of these amounts, yeah? So I'm going to put a formula in here. 1 divided by 1 plus whatever's in cell D4, and I don't want it to change when I go across the page, so I'll go with D, $D4, yeah? And then I want to raise that to the first power. Yeah? And I get this number, 92593, which you could have pulled off of a chart, yeah? And there's more to that number, but we're just showing some of the decimals because we don't care, right? Now, if I copy this across, I should get it to the second, third, fourth, and fifth power. So let's do that and see what happens. So the last number I got is 68058. Those should be the numbers that we could find on our chart, but we don't have to because we calculated it, right? This is the chart that's embedded in this gigantic spreadsheet at this point, right? This look familiar, 92, 92593. Those are the numbers. Let's go back. And there they are. Okay, 92593. Now I just got to multiply. That's going to be 1, right? Because that's day 1. So let's do this. Let's take this, multiply times 1, gives you negative 851. And let's carry this across. And the observant student will note, we used the same factor for the operating cash flow in 2025 and the terminal cash flow, because we're assuming this money is collected at the very end of 2025. So these two are discounted at the same rate. Now what? Now, if this is a good investment at 8%, we're hoping what? We're hoping this 851 is greater than these numbers here. So let's try it. What does it come out to? Add all the numbers. Comes out to 57,527 positive NPV. So we could say this investment passed the test. It gives us at least an 8% return. Since it's a positive NPV, the actual return is greater than 9%. What is the number that makes this cell right here equal to 0? What interest rate will make that happen? Now, if you had to do this manually, like you had to do it when I was in college, this would be a real pain in the neck, because you'd have to just keep multiplying times these factors. Because you don't have the same number here. It's not a nice even annuity, right? And try to get a number that makes it work. Well, let's see if 9% work, because all these factors are based on what? Whatever's in cell D4. So let's try 9%. It's still positive. Means what? It means the return is greater than 9%. Let's try 10%. Still not there yet. Let's try 0.105. Now it just went negative. So this is like the bond thing, right? We have to do a little trial and error. Okay, I got 12 bucks. I could, all right, you want me to get the exact number? I'll try. All right. That's the rate. 10.48 is the rate. It's also the internal rate of return. It's the interest rate which causes the NPV to be 0, yeah? Which we got by trial and error. You can't use any little annuity factor, right? Because why not? Because these numbers are not the same, yeah? So you got to go with this routine individually each year. That's how it works. Now, what good is that number? Well, let's suppose you were considering 5 projects, and they all had positive NPVs, but you only had enough money for 2 of those projects. Which 2 of the 5 would you pick? You'd pick the 2 with the highest internal rate of return. That's how it works. There you have it. Everything everyone wants to know about capital budgeting, but we're afraid to ask. So that's it for now. Until next time.